There's a question keeping thousands of Australian homeowners awake right now, and it's costing some of them hundreds of thousands of dollars without them even knowing it. The question is simple. Should you throw every extra dollar at your home loan and own your house outright? Or should you use that same money to buy an investment property and let tenants help build your wealth? For years, the answer felt obvious. Property always went up, rates were low, and negative gearing was generous. But in 2026, the ground has shifted under our feet. The old playbook doesn't work the way it used to. So let's walk through this properly, because the choice you make in the next 12 months could change the shape of your entire financial life. Let's start with where things stand today. The Reserve Bank cash rate is sitting at 4.35%. The average variable home loan rate for owner-occupiers is around 6.20%. That number matters more than most people realize. Every extra dollar you put into your home loan or offset account earns you a guaranteed tax-free return equal to your mortgage rate. If your rate is 6.20%, paying down your loan is like finding an investment that returns 6.20% after tax, with no risk, no ups and downs, no paperwork. To match that with shares or a rental property, you'd need to earn well over 8% before tax. That depends on your income bracket. And it's a high bar. A lot of people skip over this when they're chasing the dream of a property empire. And here's the part that stings. When someone talks about a share portfolio returning 9% or a property returning 8%, they usually mean before tax and before costs. Once you take the tax bite out, and once you take out the fees, the real number in your pocket is often much smaller than what people brag about at dinner parties. Speaking of understanding what's really happening in the markets, today's sponsor MyTrade can help with that. MyTrade is an award-winning ASIC-regulated CFD platform founded in Melbourne, giving you access to over 1,100 instruments. They've just launched a GPT-powered feature that summarizes market trends and news from the past 24 hours, so you can stay across what's moving and why. And for Aussie users, you can start with as little as $20, which makes it one of the lowest entry points for any trading platform in Australia. Links in the description and pinned in the comments. Thanks again to MyTrade for sponsoring today's video. Now let's look at the other side. The Australian property market in 2026 is nothing like the market of 2021. ANZ Research has cut its capital city growth forecast to just 2.8% for 2026. Cotality data shows Sydney values fell in the first half of the year. They're now about 2.1% below their late 2025 peak. Melbourne has been soft too. Rents, on the other hand, have hit record highs. Combined capital city house rents climbed again through the June quarter. The average gross rental yield across Australia is around 4.69%. But once you take out property management fees, council rates, insurance, maintenance, and vacancy, your net yield often lands closer to 3%. So the income from an investment property is real. It's just not the gold mine some influencers make it out to be. Then there's the tax side. In the 2026 federal budget, the government announced a big change. From the 1st of July 2027, negative gearing on established homes will be limited to new builds only. If you already own an investment property, you're safe. If you bought one before 7:30 p.m. on the 12th of May 2026, your existing setup is protected. But if you're thinking about buying an established rental from here on out, the tax perks you were counting on may not be there at tax time. That single change has flipped the maths for a lot of would-be investors. It's worth sitting with before you sign anything. Think about what that really means. A big part of the property investing story in Australia was built on the idea that losses on your rental could reduce the tax on your day job. For a lot of investors, that tax refund was the glue holding the whole strategy together. Take it away, and suddenly you're holding an asset that has to stand on its own 2 feet through rent and growth alone. That's a very different game. So let's put some real numbers on the table. Imagine you have an extra $2,000 a month to work with. Option 1 is to pour it into your offset account against a $600,000 mortgage at 6.20%. Over 10 years, you'd cut roughly 7 years off your loan, and you'd save well over $200,000 in interest, all of it tax-free. Option 2 is to use that $2,000 a month to cover the shortfall on a $700,000 investment property. If that property grows at 3% a year for a decade and pays a 4.5% gross yield, you might build equity of around $240,000. That's before selling costs and capital gains tax. On paper, the investment property looks competitive, but it comes with tenants, repairs, land tax in some states, insurance premiums that keep climbing, and the very real chance of a few months with no rent coming in at the worst time. The offset strategy gets you a similar result without any of that stress. But let's slow down here for a moment, because the numbers aren't the whole story. What you're really choosing between is two very different lives. Paying off your home gives you something almost no financial product can offer. It gives you real peace of mind. When you own your home outright, a job loss stops being a crisis. A recession stops being a threat to your family. You can take a lower paid role you actually enjoy, take 6 months off, or start a business without worrying about the bank. That kind of freedom compounds in ways a spreadsheet can't capture. On the other hand, an investment property gives you leverage, and leverage is what has made most Australian millionaires. Borrowing $700,000 to control a $700,000 asset means even small growth on the full amount turns into big returns on the deposit you actually put in. If you're young, your income is climbing, and you can handle the ups and downs, that leverage can speed up your wealth in a way that just paying off your home simply can't match. The catch is that leverage works both ways. When prices go up, your gains feel huge. When prices dip, your losses feel just as sharp, and the bank still wants its repayment every single month. That's why the timing of your first investment property matters so much, and why buying one when your finances are stretched thin is one of the fastest ways to end up selling at a loss during the next downturn. So how do you actually decide? Start with 3 honest questions. First, how safe is your income? And how would you cope if rates went up another 1% next year? If that thought makes your stomach tighten, the offset strategy is probably where you belong right now. Second, do you have at least 3 to 6 months of expenses saved somewhere safe, outside your home loan? If you don't, no investment property should be on your radar until that's fixed. Third, are you buying property because you've run the numbers? Or because your uncle keeps telling you at every barbecue that renters are throwing money away? Emotional pressure is the reason so many Australians end up with weak investment properties in outer suburbs they've never even visited. Here's the honest truth. For the majority of Australians in 2026, paying down the home loan hard through an offset account is the smarter first move. It gives you a guaranteed return that beats most investments after tax. It builds a rock-solid foundation, and it keeps your options open. Once your loan is down to around 50% of your home's value, then you can look at pulling equity out to buy an investment property. That's the sequence wealthy Australians have followed for decades, and it still works today. The mistake is thinking you have to pick one path and stick with it forever. You don't. You just have to pick the right one for the next 5 years, then reassess. Rates will move, the property market will move, tax laws will move, as we've already seen. What matters is that your decision today matches your real life, your real income, your real risk tolerance. If this helped clear the fog, do me a favor and hit the like button, subscribe to the channel and turn on notifications so you don't miss the next one. I'll see you there.